Starting your dynamic poor man's covered call campaign, your DPMCC, at the wrong moment is one of the most expensive mistakes you can make in this entire strategy. Picture it. You buy your long leap, your boat, your foundation, and the very next day the market rolls over into a correction. Your foundation loses value before it has collected a single dollar of income. You're in the hole on day one. Today, I'll show you the exact signal that tells you when the market has stabilized enough to start safely. We call it the break the 8 rule. And here's the part very few teach: how to get paid while you wait for that signal, instead of letting your cash sit there doing nothing. Remember the two-engine machine. The boat is your long leap, the directional foundation. The net is the weekly short call whose premium finances your paycheck. Everything in this system is built to protect the boat first. But the boat has one quiet enemy: time. A long leap is a decaying asset. Every day, it loses a little extrinsic value. So if you launch it into a falling market, you're now fighting on 3 fronts: the decay, the drop, and your own income. Because you're still pulling your weekly paycheck out of a boat that's already shrinking. Stack those together, and you march straight toward the 25% hard stop that ends the campaign. Good timing keeps you off that path. In our video, Reading Market Regimes, we learned to tell whether the market is bullish, neutral, or bearish. That skill wasn't academic. Entry timing is where you actually put it to work. Reading the regime tells you whether the coast is clear to launch the boat. And the rules I'm about to give you turn that reading into a precise go or no-go decision. You're not predicting the market. You're waiting for it to show its hand. You already have the tool for this. Back in the video about reading market regimes, you put the 8-period exponential moving average, the 8 EMA, on your chart. Think of it as the market's short-term speed limit. When price is trading below that line, the market is in immediate weakness. Sellers are in control. When price climbs back above it and holds, that's your first sign the selling pressure has been spent. For entry timing, that one line does a specific job. Here's the simple, quick version of the rule. And for many entries, it's enough on its own. We wait for price to break above the 8 EMA after a pullback, and then hold above it. Not a wick, not an intraday poke above the line that fades by the close. We want a full daily candle that closes clearly above the 8 EMA and then stays there for a day or two. The line that was acting as a ceiling flips into a floor. Resistance becomes support. That's break the 8. Price back above the 8, holding. That's your green light. Why bother with all this patience? Because it keeps you from catching a falling knife. Most bad entries happen when someone buys into a market that only looks cheap and then keeps falling. By demanding that price prove it can hold above the 8 EMA, you dramatically reduce the odds of starting your campaign into the continuation of a downtrend. You give up the very bottom tick. In exchange, you get a foundation that starts on solid ground. Now the more conservative version, for when you're committing real capital and want higher confidence. Instead of price alone, you ask for the fuller bullish read you already know from the video, Reading Market Regimes. The 8 EMA trading above the 21 EMA and momentum confirming, the Relative Strength Index, RSI, rising up through 50. And one trap to avoid: if price is above the 8 EMA but RSI is already overbought, up above 70, that's not strength, that's exhaustion. You'd be buying the top of a bounce that's about to reverse. So put it together. Price back above the 8 is the quick trigger. The 8 above the 21, with RSI turning up and not overbought, is the confirmation that lets you size in with confidence. Now, there's an honest problem with waiting for a signal like this. It can take weeks. The market doesn't owe you a clean break the 8 on your schedule. And in the meantime, your capital is just sitting in cash, earning nothing. For a retiree who needs this money working, weeks of dead cash is a real cost. So the question becomes, can we get paid while we wait? We can. Here's how. Instead of parking in cash, we sell a short put at the exact price level where we'd actually want to enter, not a random far-out strike chosen for premium. The strike is your target entry. Where is that level? Conceptually, in an uptrending market, we anchor to the 100-day simple moving average. In a downtrending market, we drop to the 200-day simple moving average, which sits lower and safer. And one practical filter: the strike has to pay you enough to be worth it. If the extrinsic premium on that put is less than about $50, it's not worth the risk. You wait in cash instead. How far out do we sell that put? Just 1 week, 7 days to expiration, the same rhythm as our weekly short call. There are 2 reasons. First, it keeps the whole operation on one cadence. The same weekly review that sets your levels also places the put. Second, and more important, a market regime can flip in a matter of days. A short, 1-week commitment lets you reread the market every week and adjust. A long, 30 or 45-day put would lock you into a level the market has already moved past. From there, only 2 things can happen, and you're productive in both. Outcome 1. The market stays above your strike. The put expires worthless, and here's how we handle what you collected. You pay yourself the premium as your paycheck, but anything above about $150 gets banked toward your future boat. Real income while you wait, with the surplus quietly strengthening your foundation. Outcome 2. The market falls to your level and you're assigned. The market has finally handed you the entry you were waiting for. Now, most people hear assigned and think something went wrong. In this system, it's the opposite. Assignment is a planned event. The entire reason we were waiting was to get in at a lower price than today. An assignment means the market came down to our level. In an uptrending market, that level is the 100-day average. And even if a quick dip takes you below your strike, that is not catching a falling knife. Entering near the 100-day in an uptrend has long been a good entry. In a downtrending market, your level is the 200-day. And there, yes, technically you are catching a falling knife. But entering at the 200-day has been a reliable long-term entry point for decades. Either way, you entered where you decided to, not where fear told you to. So you've been assigned the shares. What now? You don't just sit on stock. That's not our strategy. Here's the bridge rule with one smart adjustment. On a normal week, you'd take up to $150 of that put premium as income. But in an assignment week, it's more prudent to skip the paycheck and put the entire premium into the boat instead. It reduces your loss and builds cushion exactly when you need it. Then you sell the assigned shares, take that loss against the boat, and use the capital to buy your 80 delta long leap, the deep foundation from the video, How to Pick Your Leap Strike. And the 4th step, you sell your first 1-week short call against it. That's the net going up over the boat and the first paycheck of the campaign. The wait is over. The 2-engine machine is finally starting to run. One honest word before we finish, because I won't sell you a free lunch. A short put is a real obligation. If you're patient and the market comes to your level, you very likely will be assigned. And in this system, that's the plan, not an accident. The discipline that makes it safe is sizing. Only sell puts on capital you actively want to deploy into a full campaign. Exactly the discipline from our last video, position sizing for a retirement account. Never sell a put you wouldn't want to be assigned on. That's the shift in mindset. Sooner or later, you will be. Let's bring it together. You wait for the signal, price breaking and holding above the 8 EMA for the quick read, or the fuller 8 above 21 with RSI confirming when you want more certainty. While you wait, you get paid. A 1-week put at your entry level, the 100-day average in an uptrend, the 200-day in a downtrend, paying you your weekly paycheck and banking the surplus toward your boat. And if you're assigned, you bridge in. Bank that whole week's premium into the boat, sell the shares, buy the 80 delta long leap, and sell your first weekly short call. Signal, wait, bridge, go, and the campaign is live. That's how you time your start without either rushing in or sitting idle. Next time, we put it all on the table. A full campaign setup on SPY and QQQ, with real strikes, real prices, and a real entry. I'll see you there.